Here's a truth most traders can't face. Your next 10 trades will expose exactly who you are. Not what indicator you use. Not which guru you follow. Who you are when the market tests your nerve. These 10 trades are a mirror reflecting your impulses, fears, and self-control. And the reflection doesn't lie. You might believe your edge lies in your setup, but the market doesn't pay for setups. It pays for discipline. Jesse Livermore understood that long before trading psychology had a name. He once said, "It was never my thinking that made the big money, it was my sitting." But what did he mean by sitting? Was he talking about patience or paralysis? Waiting or fear? Sitting through what, exactly? The amateurs never ask that question. They hear the quote, nod, and move on to the next trade alert. The professionals stop and realize Livermore wasn't sitting for comfort. He was sitting through discomfort. Through the waiting, the uncertainty, the temptation to click when he shouldn't. Sitting was a form of strength, a position of control, not passivity. That's the essence of this challenge. You can flip a coin 10 times and still get heads 6. That doesn't mean you've mastered probability. Likewise, you can win 6 out of 10 trades and still end the week broke. Why? Because what destroys traders isn't accuracy, it's inconsistency. It's the one oversized loss, the impulsive re-entry, the revenge click after a stop-out. Every professional knows this. The market doesn't need to beat you often. It just needs you to make one emotional mistake at size, one deviation from your plan, one moment of self-sabotage disguised as intuition. That's all it takes to erase a week of perfect decisions. And it happens not because you lack skill, but because you've never faced your habits in sequence. 10 trades, lined up like dominoes, reveal everything. Amateurs chase perfect entries. Professionals chase perfect behavior. It sounds simple, but it's the dividing line between survival and extinction. The 10-trade challenge is your mirror. 10 trades, 1 week, 1 question: can you act like Livermore? Can you manage your size, your stops, your silence? Or will you break by trade number 3? The rules are brutal in their simplicity. No overtrading, no averaging down, no moving stops. Just this once. Each trade becomes a confession of your habits. Each habit becomes a prophecy of your fate. Livermore learned these lessons not from theories, but from ruin. He paid for them in drawdowns and restarts. When he said the market teaches through loss, he wasn't being poetic. He meant it literally. Each dollar lost was a tuition fee. He didn't resent it, he studied it. Most traders, after a bad day, drown in excuses. They say, the market was manipulated, or news killed my setup. Livermore would ask a different question. What part of me was untrained? That's what this challenge forces you to confront. Not the market's randomness, but your own. Think about the way you feel after a win. Your pulse slows. Your confidence swells. You start scanning for the next trade before the current one has even closed. That's not strategy, it's addiction. It's the high of being right. Livermore saw that pattern early in his career. After a few big wins, he felt invincible. Then, the market humbled him instantly. He discovered that the danger of winning is that it blinds you to the possibility of error. It whispers, "You've got it now. You can go bigger." And that whisper has bankrupted more traders than any bear market. That's why Livermore's greatest rule was never to increase size after a win. The amateur grows aggressive with success. The professional grows cautious. Winning is no signal to relax, it's a signal to tighten discipline. Now consider the opposite. The feeling after a loss. The body tenses. You want to recover, to get it back, to prove you weren't wrong. That's the trap. Most traders don't realize their biggest losses come after they've tried to fix a small one. The professional never fixes. They exit, review, and reset. They cut without hesitation, without emotion. To them, a loss isn't personal, it's procedural. That detachment is what this challenge is built to train. You're not tracking profit and loss, you're tracking patience. You're not trying to prove a method, you're trying to prove control. If you take this seriously, these 10 trades will exhaust you, not financially, but mentally. You'll feel resistance when you sit on your hands for hours. You'll feel anxiety when a setup appears and you're unsure. You'll feel ego when a win tempts you to size up. Every one of those moments is the market's voice asking, "Are you still in control?" Livermore faced that question daily. He understood that mastery isn't about predicting the next move, it's about surviving the wrong ones. Livermore used to say, "The market is designed to fool most of the people most of the time." That's not cynicism, it's mathematics. The majority lose because the majority act from emotion. If you can make 10 trades in a row without breaking your rules, you've already separated yourself from 90% of participants. It's not the outcome of those 10 trades that matters, it's the integrity of your execution. Did you size small? Did you wait for confirmation? Did you take the loss without negotiation? If yes, then you're already trading on Livermore's frequency. Think of this challenge as a psychological fast. You're abstaining from chaos. You're resetting your nervous system. You're training your instinct to hesitate at the right time. Each trade is an experiment in discipline. Your equity curve might wobble, but your mindset will sharpen. Professionals understand that the real edge is emotional endurance. 10 trades become a crucible, burning away the noise and leaving only process. Livermore's brilliance wasn't that he was smarter than others. He simply observed what the crowd ignored. He noticed that most traders were slaves to activity. They equated movement with progress. But markets don't reward motion. They reward timing. The amateur trades to feel involved. The professional waits to feel aligned. Livermore could spend days doing nothing because he knew doing nothing was a decision, a profitable one. Waiting is a position. That phrase alone separates the impulsive from the elite. By the end of this challenge, you'll start to see patterns not in price but in yourself. You'll notice when impatience spikes, when greed whispers, when fear distorts your logic. When the prospect is, you'll recognize the emotional fingerprints behind every click. And once you see them, you can control them. That's when trading becomes less about prediction and more about precision. You'll stop asking, "What will the market do?" and start asking, "What will I do when it does?" That's the shift from amateur to professional. Imagine Livermore sitting in his office during a roaring bull market, surrounded by the noise of tickers and telephones, prices surging, brokers shouting, and yet he's motionless. Everyone else is chasing. He's waiting. He's not afraid of missing out because he knows opportunities that are truly his will wait for confirmation. That's not hesitation. That's authority. That's what you're training, in these 10 trades, the authority to not react. But there's one more truth you must face. Even Livermore, with all his brilliance, broke his own rules. He was human. He made fortunes, then lost them, then built them again. His strength was not in perfection, but in persistence. The 10-trade challenge isn't about flawless execution. It's about awareness, catching yourself faster, recovering cleaner, acting with intention. That's how professionals compound, not through streaks of wins, but through streaks of discipline. So before you begin, take a breath and ask yourself a single question. If you were forced to trade like Livermore for 1 week, could you? Could you size small, sit tight, and accept boredom as part of the craft? Could you resist the urge to move a stop because a candle looks threatening? Could you let the market test you without reacting? Most can't. They crack by trade number 3. They abandon the challenge halfway, claiming conditions changed. Professionals know conditions always change, that's why they build unchanging rules. These next 10 trades are not about profit. They're about proof. Proof that you can act with patience under pressure. Proof that your edge is behavior, not luck. Proof that restraint is the rarest skill in finance. Livermore once said that markets are never wrong, only opinions are. So the question becomes, will your next opinion be disciplined or desperate? That answer, over these 10 trades, will define your future. Because the truth is, this challenge never ends. It's just disguised as 10 trades. Every trade after that is a continuation, a test of character in the face of randomness. Livermore mastered that test because he stopped trying to win every battle. He learned to win the war of behavior. He accepted that loss was part of progress, boredom part of brilliance, and silence part of strategy. So here's your assignment. 10 trades, 1 week, 1 mindset. Think like Livermore. Trade like a professional. Wait like a predator. Cut like a surgeon. No excuses. No exceptions. If you can finish this without breaking a rule, you'll have done something few ever achieve. You'll have proven that you can trade not just with capital but with character. And that, more than any chart pattern or algorithm, is what separates the amateurs from the immortals. Because in the next chapter, you'll see how Livermore learned his first $1 million lesson not from a gain, but from the trade that almost ended him. The story of how early success became his greatest curse, and how losing taught him the truth every professional must eventually learn, that survival, not victory, is the real goal of the game. Livermore's first big win came shockingly fast, almost unnervingly so. He started with a few $100s, trading in bucket shops, small, informal exchanges where one could speculate on price movements without actually taking delivery of shares. Within weeks, those hundreds became thousands. The rush of seeing numbers multiply on a ledger that fast was intoxicating. He felt invincible, as though he had unlocked some secret formula for the market, some insight that others could never see. In the back of his mind, however, a quiet, almost imperceptible caution whispered. He brushed it away. After all, the charts were confirming his moves. The money was real, the results tangible. He told himself he was a genius, a natural. The problem was, the environment he dominated was fragile, structured to reward luck as much as skill, designed to exaggerate early wins. He didn't yet understand that success in a controlled or simplified arena was nothing like surviving the chaos of the real exchange floor. When Livermore stepped onto that floor, everything changed. Suddenly the markets were alive with complexity, a violent combination of volatility, slippage, and emotion. Orders didn't fill exactly as expected. Prices jumped faster than he could react. Patterns he had trusted crumbled under the weight of real liquidity. The very rules that had made him money before now failed him. He realized, with a jolt, that the difference wasn't the market itself. It was him. His psychology, his ego, his impulsiveness, these had gone untested during his early streak. The amateur mindset had convinced him that he was smarter than the market. The professional mindset, which he had yet to fully adopt, required humility, restraint, and a respect for forces beyond one's control. Early success had been a mirror, but a distorted one, reflecting confidence more than competence. Amateurs mistake early wins for mastery. They see the gains, feel the rush, and conclude that they have been endowed with an innate edge. Professionals, on the other hand, recognize early success as a test. It tempts you to oversize, overtrade, and overestimate skill exactly when caution is most necessary. That's when the market begins to collect its tuition. Every market participant eventually pays, but those who overinflate their ego on the first gains pay more. Livermore learned this lesson the hard way. He came to internalize his own aphorism: the market is designed to fool most of the people most of the time. That phrase isn't merely a pithy observation. It's a rule for survival. It's a reminder that early triumph is often a trap, an illusion meant to lure the overconfident into disaster. This leads to the first rule of the 10-trade challenge. Never increase your size after a win. That rule is deceptively simple, yet profoundly difficult to follow. The natural human impulse after a successful trade is to double down, to capitalize on momentum while your confidence is high. The amateur does precisely this. They misinterpret emotion as signal and instinct as insight. The professional, however, adds size only after confirmation, after statistical or technical evidence validates the move. It's a distinction that seems trivial until you witness the consequences of ignoring it. One builds pyramids of logic, the other builds castles of emotion. One stands the test of time, the other collapses the moment the wind shifts. Consider your own recent winning streak. Did it make you cautious, disciplined, observant, or did it inflate your sense of infallibility? Imagine doubling your position on trade number 4, riding the high of prior wins. Could you still navigate trade number 7 if the market shifted? If a sudden spike forced you to adjust your stops or scramble for margin, would your capital and your composure survive? Most traders answer no, and that's why early success is more dangerous than repeated losses. Losing teaches humility. Winning prematurely teaches hubris. Livermore discovered that controlled loss was more valuable than unrestrained gain. After stepping onto the exchange floor, he realized that survival depended not on his ability to identify winning trades, but on his ability to manage losing ones. The stakes were higher, the tempo faster, the pressure greater. The early wins he once celebrated now served as a cautionary tale. Confidence, when untested, is a liability. He learned to regard every gain skeptically, every profit as temporary, every success as a potential trap. That mindset became the foundation of his discipline. Early success also revealed a hidden paradox. The more money he made, the more attention he drew. Brokers, competitors, the crowd all seeking to test, challenge, and exploit him. The amateur interprets attention as validation. The professional interprets it as a test. And so, the very wins that were supposed to signal mastery became invitations to error. Livermore began to understand that the market doesn't care about reputation or previous success. It cares only about the present. Each trade is independent, unyielding, and unmerciful. He also observed a pattern among other traders, one that has repeated throughout history. Beginners who score early gains often over-leverage, chasing excitement. They forget that luck is not skill. A few favorable moves create the illusion of control, inflating both ego and position size. The market, in turn, enforces reality swiftly. Even a minor misjudgment can lead to outsized losses. Professionals, conversely, see early wins as neutral events. They take note, record the data, and proceed according to the process, not the emotion. They recognize that the real edge is consistency, not raw profit. It's critical to note that early wins also test patience. The amateur, thrilled by quick profits, seeks to replicate them immediately, often abandoning analysis or risk management in the process. The professional pauses, observes, and lets patterns confirm themselves. Livermore learned to resist the seduction of immediacy. He saw that jumping at every apparent opportunity leads to fatigue, error, and erosion of capital. Timing, not frequency, creates lasting success. Waiting becomes as much a weapon as a trade itself. The psychological pressure of early success is profound. Human beings are wired to seek reinforcement, to repeat behaviors that reward them emotionally. Early wins trigger dopamine, which in trading can cloud judgment and encourage impulsive scaling. Livermore became acutely aware of this. He noted how his mind sought to stretch winning positions prematurely, and how temptation increases with each victory. The lesson he codified is now timeless. Never mistake temporary fortune for skill, and never let euphoria dictate size or timing. There is also a social component. Traders who win early attract attention, whether from peers, mentors, or competitors. They are lauded, envied, and scrutinized. The amateur basks in this validation, letting it reinforce risky behavior. The professional uses it as a lens for self-examination, asking constantly, "Am I acting according to rules or ego?" Early wins magnify this test, because the market rewards caution more than applause. Livermore's insight was that reputational risk is trivial compared to capital risk. Survival comes first, recognition later. Early success is often misunderstood as mastery, yet it is in fact a diagnostic tool. It exposes tendencies toward overconfidence, impatience, and emotional scaling. Livermore's breakthrough was understanding that these tendencies, left unchecked, destroy capital far faster than bad luck ever could. One premature expansion of size can wipe out multiple careful trades. One failure to respect volatility can erase weeks of gains. The lesson is clear. Control your response to early wins. Let the market confirm strength. Let logic, not emotion, dictate scale. The amateur sees early profit as license. The professional sees it as warning. Each winning trade is an experiment, a piece of feedback on psychology, not a golden signal of skill. Livermore's first exposure to this reality came at a cost. His early streak ended abruptly, humbling him, teaching him the difference between confidence and competence. He realized that protecting capital required a mindset shift. Treat every early win as provisional, maintain small size, and prepare for inevitable loss. The discipline required to follow this principle is what separates consistent traders from those doomed to repeat cycles of gain and ruin. Livermore's experience in the bucket shops versus the real exchange floor is more than anecdote. It is a metaphor for every trader's evolution. The transition from naive confidence to strategic humility is paved with early victories that test, tempt, and ultimately teach. The trader who understands this principle survives. The one who ignores it pays tuition in full. This distinction, subtle yet profound, forms the backbone of professional behavior: control, observation, and calculated scaling. The 10-trade challenge embodies this lesson. Rule number 1 is designed to prevent the very trap that ensnared Livermore and countless other traders: the seductive illusion of early mastery. By refusing to increase size after a win, the trader enforces discipline, enforces humility, and ensures survival. The market doesn't need amateurs to fail. It provides enough volatility and randomness for them to self-destruct. Early wins are dangerous only if you misinterpret them. Professionals, however, treat them as data points, never mandates. They add only when confirmation validates their strategy, never when euphoria tempts them to guess. Now, imagine yourself completing the first 3 trades of your week. The first one wins, small but satisfying. The second, another modest gain. The third, your intuition tells you it's time to capitalize, to expand. This is the moment the 10-trade challenge targets. Do you honor the rule of size, discipline, or do you let early success dictate behavior? Livermore faced that decision repeatedly, often paying dearly when he failed, and consistently thriving when he followed process. Understanding this distinction transforms 10 trades into 10 lessons about restraint, patience, and consistency. Early success, paradoxically, is more perilous than early loss. Loss teaches humility. Profit teaches vigilance. That is why professionals, from Livermore to today, treat small wins as provisional and leverage only after repeated confirmation. The pattern is simple yet profound. Avoid hubris, preserve capital, observe behavior, and allow the market to validate strength before scaling. This is the principle that will prepare you for the next lesson in the 10-trade challenge, where you will confront the real power of losing small, the cornerstone of survival, and the defining behavior that transforms amateurs into professionals. Because the most important lesson from early success is this: every win is temporary, every risk is permanent, and your discipline is the only enduring edge. Only by internalizing that principle can you survive the next 10 trades, let alone the next 10,000. Once you accept this, you step out of the trap and into the mindset of the true professional, the one who uses early wins as mirrors of behavior, not as signals of omnipotence. And that mindset will guide you as you enter the next stage, where learning to lose small becomes the ultimate key to longevity in the market. Livermore once said, "A loss never bothers me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does damage." The words reveal a truth few traders internalize. It is not the loss itself that kills profits, but the hesitation to acknowledge it, the stubborn refusal to act when the market signals you are wrong. Most traders treat losses as punishment, a reflection of inadequacy, or a personal failure. They clutch losing positions, hoping, praying, bargaining with the market in ways that only deepen their pain. Professionals, by contrast, treat losses as tuition, a fee paid for the privilege of learning, for the opportunity to refine rules, discipline, and judgment. In the 10-trade challenge, this distinction is everything. The second rule is clear. Cut every loss without hesitation. Set the stop, respect it, and move on. Do not argue with the tape. Do not invent reasons why this time it is different. When you refuse to take a small loss, you invite a large one. When you delay, you donate. That is not a metaphor. It is arithmetic. Every extra tick against you increases risk exponentially. Every delay is a tax on capital and emotion. The market does not negotiate. If you are wrong, the market will punish you. Acting promptly is the only shield. Many traders underestimate the power of small losses. Livermore built fortunes not through flawless predictions or perfect entries, but by mastering exits. He could lose 5 trades in a row and still finish the week profitable because his sizing was controlled and his stops respected. This was not luck. It was discipline, grounded in numbers. Each trade had defined risk. Each exit was predetermined. By strictly enforcing limits, he ensured that no single mistake could derail his entire account. That principle, simple yet profound, underpins professional survival. A trader who fears small losses will inevitably face a catastrophic one. The smaller the individual loss, the greater the capacity for recovery. The paradox is that limiting losses grants freedom. Freedom to wait for high-probability setups. Freedom to think clearly. Freedom to act decisively when opportunity arrives. Every restriction of loss expands liberty, a concept rarely grasped by those who equate loss with weakness. This arithmetic discipline extends beyond numbers. Every trade is a test of ego control. Amateurs protect pride. They refuse to admit error because it threatens identity. They argue with the tape, rationalize, justify, or hope. Professionals protect capital. They recognize that pride is a luxury the market does not permit. Every loss is impersonal. Every exit is a procedure. Observing this separation between ego and execution is what elevates trading from gambling to craft. In your 10-trade challenge, focus obsessively on how quickly you act when the trade moves against you. Track the lag between signal and execution. Measure the emotional response as rigorously as the profit and loss. Those who master this component of trading are the ones who survive repeated failures and compound gains. Consider a typical scenario. You enter a trade aligned with your rules, but price moves against you. The amateur panics or freezes. They move stops, hold longer than planned, or exit emotionally at a worse price. The professional, however, executes instantly. The stop is hit, the loss is taken, and attention shifts immediately to the next opportunity. No drama, no self-flagellation, no lingering anxiety. This behavior is deliberate. It is cultivated through repeated practice. Each cut is a reinforcement of discipline, each loss a lesson in control. In time, small losses become almost invisible to the professional, just the price of tuition and a means to maintain operational capital. There is also a cognitive shift that accompanies disciplined exits. The smaller your losses, the less mental baggage you carry, and the sharper your judgment becomes. A trader unburdened by a large, lingering loss can see opportunities with clarity, evaluate setups without emotion, and wait patiently for confirmations. This is the essence of freedom through limitation. By constraining damage on one side, you expand optionality on the other. Livermore recognized this early. He understood that trading is not a contest of bravery, but of patience and measured responses. The ability to act swiftly when wrong and wait when right defines the professional mindset. It is important to note that cutting losses is not a passive act. It is proactive. It is taking control before circumstances dictate outcomes. Professionals internalize this principle so deeply that it becomes instinctual. They do not debate whether the market is wrong. They do not bargain with charts. They accept the reality presented and respond accordingly. That immediacy in response rather than delayed justification is the hallmark of mastery. Every trade becomes a controlled experiment in behavior, not a desperate plea for validation. Amateurs, conversely, often misinterpret the absence of immediate profit as failure. They assume that exiting early or taking a small loss is a sign of weakness. They fail to see that the real danger lies in allowing losses to accumulate beyond their calculated thresholds. The professional inverts this thinking. The smaller the loss, the greater the capacity to survive, adapt, and capitalize on future trades. This inversion is counterintuitive yet foundational. It flips conventional trading psychology on its head, teaching that surrendering a little today preserves the ability to fight another day. Livermore's own trading was punctuated by this philosophy. In his journals and reflections, he repeatedly emphasized that discipline in loss management was more valuable than talent in prediction. He could endure losing streaks without stress because his capital at risk was tightly defined. This allowed him to sit quietly during the next opportunity, to act decisively, and to compound gains over time. The lesson is timeless. Size properly, stop quickly, and never allow emotion to dictate the exit. The professional operates with precision, the amateur operates with hope. Another dimension of this principle is its role in mental clarity. A trader who accepts small losses quickly avoids the psychological fatigue that comes from unresolved trades. Each small loss becomes a clearing event, a way to reset the mind, the account, and the plan. Conversely, the amateur accumulates psychological debt with every lingering losing position. Anxiety rises, decision-making deteriorates, and the clarity needed to identify true opportunity is obscured by fear, anger, and regret. Livermore's insight was that managing losses efficiently was not just arithmetic, it was cognitive hygiene. Clear capital, clear mind, clear decision-making. The 10-trade challenge emphasizes this principle by structuring each trade as a microcosm of risk management. Every trade provides immediate feedback on your ability to enforce stops. Your task is to observe reaction times, emotional responses, and adherence to rules. By the end of 10 trades, patterns emerge, where hesitation appears, where ego interferes, where fear or hope dictate action. Each identified flaw is a stepping stone toward mastery. Cutting losses becomes not just a tactical choice, but a behavioral foundation for sustained performance. Consider how small, disciplined losses affect compounding. By limiting the downside on each trade, a trader preserves capital for high-probability setups. Gains can then accumulate without the drag of emotional or financial strain from large setbacks. This is the engine behind professional trading. Arithmetic discipline enables mental and financial flexibility. The smaller the loss, the greater the opportunity to act decisively when conditions are optimal. The paradox is elegant. Loss management fuels freedom. Freedom fuels opportunity, and opportunity fuels growth. It is worth emphasizing that this principle also cultivates humility. Accepting a small loss is an acknowledgement that the market is stronger than the individual trade. It reinforces respect for forces beyond immediate control. Humility, in turn, reduces overconfidence, curbs impulsive decisions, and strengthens adherence to process. He said, Livermore understood this instinctively. His wealth was built not on never being wrong, but on always acting correctly when wrong. The professional does not cling to pride. They cling to process. Every trade, then, is a lesson in behavior rather than prediction. The market provides data, the stop provides structure, and the trader's reaction provides insight. By focusing on losses first, the professional ensures survival. By taking them swiftly, they maintain freedom. By treating each loss as tuition, they accelerate learning. This is the sacred art of losing small, a skill more valuable than insight, more durable than intuition, and more profitable in the long run than any single winning trade. Finally, consider how this principle sets up the next step: sitting on winners. Once you have mastered the discipline of cutting losses, you create the mental and financial capacity to let profits run. The art of losing small directly enables the art of waiting on gains. Every stop executed without hesitation reinforces patience, ensures flexibility, and strengthens the edge when the market finally confirms your position. Professionals do not exit winners prematurely because they have internalized the power of structured risk. The loop closes. Discipline in defense allows discipline in offense. Amateurs fear loss and grasp at winners. Professionals manage loss and allow winners to flourish. By the end of the 10-trade challenge, focusing on losses first transforms the way you view every trade. You begin to see that cutting loss is not defeat, it is preservation, it is freedom. It is the means to continue playing at a high level, trade after trade, day after day. Livermore's wisdom is clear. The path to long-term success is paved with small, controlled losses and the unshakable discipline to execute them without hesitation. The smaller your losses, the larger your opportunities, the sharper your mind, and the greater your eventual gains. The true professional learns to embrace loss, not fear it, to act decisively, and to protect the capital and freedom necessary to thrive in a market that is, by design, unforgiving and relentless. And so, in your 10-trade challenge, let every loss be a lesson, let every stop be a demonstration of control, and let each moment of hesitation become a point of observation. The sacred art of losing small is not merely a tactic, it is the foundation of trading life. Master it, and you position yourself to not only survive, but to capitalize repeatedly on opportunities that the amateur cannot even see. It is the discipline of defense that allows for the freedom of offense, and it is this principle that will prepare you for the next phase. Learning to sit on winners, to let profits grow while others panic, and to transform the small victories, secured through disciplined exits into exponential gains through patience, clarity, and conviction. Livermore made millions not by trading more, but by trading less. The markets reward patience far more than activity, a truth that continues to elude the majority of traders. Rule number 3 of the 10-trade challenge is deceptively simple yet profoundly difficult to follow. Waiting is a position. Every moment you resist the urge to click, every pause before entering a trade, every rejection of opportunity that doesn't meet your criteria, these are acts of capital protection disguised as inactivity. Amateurs feel uncomfortable in silence. Their fingers itch for action. Their minds buzz with imagined patterns. Their emotions demand engagement. Professionals, however, thrive in it. They understand that the tape whispers long before it shouts and that only those who wait can truly hear it. Each second spent observing is a second of intelligence gained. Every forced action is a tax on judgment. Livermore called it sitting tight. He often spent weeks doing nothing, sometimes months. This was never laziness, never indecision. It was discipline, the conscious choice to act only when the market aligned perfectly with his hypothesis. He waited for the pivotal point, the moment of confirmation when probability and price structure converged. He said, "After spending many years in Wall Street, and after making and losing millions of dollars, I want to tell you this. It was never my thinking that made the big money, it was my sitting." Notice that he did not attribute success to brilliance, or speed or intuition alone, but to the ability to remain still, to resist the gravitational pull of impatience. The market will always provide signals. The question is whether you have the patience to let them emerge clearly. In the 10-trade challenge, this principle translates into rigorous selectivity. You are not just taking trades, you are rejecting 90% of them. Every non-click is a test of discipline, every refusal a demonstration of process mastery. The amateur hates this. They see nothing happening and panic, believing that inactivity equals opportunity lost. The professional, however, recognizes the value of waiting. Each passing trade that is ignored preserves capital, sharpens judgment, and prepares the mind for the trade that truly matters. The difference is subtle but profound. One approach accumulates loss and noise. The other accumulates clarity and edge. Think of trade number 6 or 7. You followed rules, cut losses efficiently, and avoided the lure of early wins. Now the tape moves slowly. Patterns are ambiguous. Candles form but do not confirm. A faint itch arises, a psychological compulsion to do something. This is where amateurs break. They initiate positions from boredom, from the desire to feel engaged rather than from probability. Each impulsive click taxes discipline, risks capital, and amplifies emotional strain. Professionals, by contrast, view this discomfort as a feature, not a flaw. The urge to act is an indicator of human weakness. Sitting tight is the real trade. Patience in this framework is an asset as tangible as any profit. Sitting tight is not passive observation. It is an active, strategic position. You monitor the tape, analyze volume, observe pivots, and prepare mentally for confirmation. Waiting allows probability to accumulate. It allows false signals to die and true setups to assert themselves. Livermore mastered this dynamic. He did not chase every breakout, nor did he react impulsively to every rumor. He observed until the market's behavior aligned with his thesis. Only then did he commit. The amateur sees hesitation as weakness. The professional sees it as leverage. Sitting is the precursor to precision. This philosophy also reframes your perception of time in trading. Many traders treat latency as loss. Every minute without a trade feels wasted. Professionals understand that time is not the enemy. Uncertainty is. By embracing the waiting period, you allow probabilities to favor you. Each rejected setup reduces exposure, mitigates risk, and compounds the value of the eventual confirmation. Boredom is not wasted. It is preparation. Sitting is not stasis. It is strategic positioning. Consider the psychological discipline required. The human brain craves movement, completion, and validation. Sitting still under uncertainty triggers discomfort, anxiety, and second-guessing. Yet each moment of deliberate inaction is a step toward mastery. By sitting, you reinforce the principle that action without alignment is costly. By resisting the urge to act, you strengthen the behavioral patterns that prevent overtrading and impulsive loss. In effect, patience becomes a defensive mechanism, a buffer against the chaos of the market. There is also a compounding effect to waiting. By refusing trades that do not meet criteria, you conserve capital, reduce emotional fatigue, and preserve cognitive clarity. This preservation allows you to act decisively when the pivotal trade arrives. The professional sees this as opportunity. Each rejected trade increases the relative value of the next valid setup. Waiting accumulates edge. Acting prematurely squanders it. Livermore's genius was in recognizing that the market is patient. There is always another setup. There is always a pivotal point. There is always confirmation if you can endure the wait. Waiting is also a tool for confirming conviction. Many amateurs enter trades at the first hint of momentum, mistaking motion for signal. Professionals wait until conviction is undeniable. Volume confirms price. Patterns align. Tape corroborates thesis. Only then do they engage. This discipline reduces risk and increases expected value. It transforms trading from gambling into probability-based decision-making. Sitting tight, therefore, is not inactivity. It is the strategic accumulation of intelligence. The 10-trade challenge emphasizes this principle by forcing you to endure long periods without action. Trades will be scarce, setups fleeting, and signals ambiguous. The challenge is not to force engagement, but to resist it. Each non-trade becomes a demonstration of process adherence. Each rejected setup reinforces the idea that market participation without alignment is expensive. You begin to internalize the notion that patience is not avoidance, it is preparation, and that preparation compounds over time. Another subtle dimension is the relationship between waiting and emotional clarity. When trades are scarce, emotions rise. Fear, greed, and boredom compete for attention. By sitting through these states without acting, you learn to observe them objectively. You identify triggers, recognize impulses, and develop resilience. Professionals treat this as essential training. Amateurs succumb to it. Over time, patience transforms from discipline into instinct. Sitting tight becomes effortless because the trader's mind is calibrated to recognize only high probability alignment. This philosophy also reframes the perception of risk and reward. Acting prematurely increases exposure to noise and false signals. Waiting reduces unnecessary risk, allows for better entries, and increases potential reward relative to capital at risk. In essence, patience optimizes the risk-reward equation. Each moment of silence is a micro-hedge, a defensive maneuver that maximizes optionality. Livermore intuitively understood that the less you trade without confirmation, the more potent your confirmed trades become. There is a paradox here. Trading less often, yet trading better. Many amateurs equate activity with productivity. They see a flurry of trades as success, regardless of outcomes. Professionals invert this logic. They understand that each click has a cost, that each forced position carries latent risk, and that the true measure of competence is not frequency, but precision. Waiting, therefore, is the most active form of engagement. It demands observation, analysis, patience, and conviction. It is the hardest trade of all. By sitting tight, you also preserve flexibility. Capital is available, cognition is clear, and the trader is free to respond decisively when the market signals true alignment. Every rejected trade is a rehearsal in patience, every unclicked opportunity a lesson in restraint. Professionals understand that waiting does not diminish opportunity, it amplifies it. The moment of confirmation carries exponentially more value than any impulse-driven entry could. Imagine sitting through trade number 7, feeling the itch, seeing the charts twitch, and resisting the urge to act. This is the crucible of professional development. Each resisted temptation reinforces discipline, strengthens adherence to process, and preserves both capital and psychological bandwidth. The amateur cannot endure this. Impatience overrides judgment, greed overwhelms process, and the cycle of impulsive loss continues. The professional, however, sits quietly, accumulating edge until probability aligns in their favor. Livermore often remarked that the market never owed him a trade. Opportunities were not a right. They were earned through observation, alignment, and patience. This mindset turns waiting from a psychological burden into a strategic weapon. Each moment of inaction becomes a preparation, each rejection of noise a compounding advantage. Waiting is not passive. It is the precursor to precision, the foundation of scaled gains, and the pathway to building positions without compromise. Finally, consider how this principle connects to the broader arc of the 10-trade challenge. By mastering the discipline of waiting, you prepare yourself to act decisively when confirmation appears. The next rule, the art of pyramiding, depends entirely on this foundation. Only a trader who has internalized patience, who can sit through ambiguity, and who understands the true value of waiting, can leverage small positions into significant gains. Without this discipline, pyramiding becomes reckless scaling, hope masquerading as strategy. Every click, every hesitation, every rejected setup in trades 6 or 7 is a lesson in self-mastery. Patience protects capital, sharpens judgment, and prepares the mind for confirmed opportunity. Amateurs trade boredom, professionals trade confirmation. The discipline of waiting turns idle observation into actionable intelligence and transforms restraint into a strategic weapon. This is the stage where the professional mindset solidifies, where patience is codified as power, and where every silent minute spent observing the tape compounds into future profit. In the next chapter, we will close the loop, exploring how Livermore turned this patience into profit. Pyramiding strength, not hope. Waiting will meet action, and discipline will translate into compounding, positions that magnify gains without amplifying risk. The journey from patience to aggressive precision is the culmination of the lessons in this 10-trade challenge. The bridge from survival to mastery, from restraint to calculated expansion. By mastering waiting, you prepare for pyramiding, the professional's method of transforming discipline into exponential reward. By the time Livermore entered his prime, he had experienced the full spectrum of fortune and failure. He'd built and lost several fortunes, often in rapid succession, and learned the market's lessons in the harshest way possible. Yet when he won, he didn't just earn a profit, he multiplied it. His secret was not clairvoyance or perfect prediction. It was pyramiding, the disciplined art of scaling into strength. Rule number 4 of the 10-trade challenge encapsulates this principle. Add to strength, never to weakness. The distinction is subtle but profound. Amateurs average down to feel right, to soothe the discomfort of a losing position. Professionals pyramid up to be proven right, to align their capital with confirmed market behavior. This is the final evolutionary step in professional trading. Taking small positions, letting the market validate them, and layering additional exposure only as evidence mounts in your favor. Pyramiding begins with entry. Livermore would start small, respecting risk and acknowledging uncertainty. The initial position was never a declaration of certainty. It was a test of probability. Then he would wait for confirmation. The tape, price movement, volume, and momentum converging to reinforce his thesis. Each subsequent addition, layer by layer, was a vote of confidence from the market itself. It was the market giving permission to expand, to reinforce conviction with capital rather than ego. This approach transforms trading from guesswork into logic-based compounding. Every added layer carried reduced psychological tension because it was justified by observation rather than hope. The amateur, by contrast, scales into losses or doubles down emotionally, hoping that the market turns around. The difference is night and day. Pyramiding correctly is reinforcement. Pyramiding incorrectly is gambling. The arithmetic of pyramiding is elegant. Imagine starting with $10,000, risking a small fraction on an initial position. The trade moves in your favor. You add a second layer with profits from the first, or with idle capital. As price confirms again, a third layer follows. By the time the trend matures, what began as a modest position has become substantial, yet risk remains controlled. This is how Livermore transformed relatively small initial capital into millions, not by reckless leverage, but by disciplined logic. Each step compounds gain while maintaining respect for risk. Capital grows in proportion to confirmation, not hope. This is the fundamental divergence between amateurs and professionals. The former seeks excitement and validation. The latter seeks probability and process. The emotional clarity required for pyramiding cannot be overstated. It demands patience, confidence, and discipline. You must resist the temptation to act too soon or scale prematurely. You must let the market do the work of confirming your thesis. Layering into strength is not about asserting dominance. It is about alignment. Each increment of capital added is a reflection of reinforced probability. When executed correctly, pyramiding creates a virtuous cycle. Disciplined observation informs measured action. Action produces confirmation. Confirmation justifies further scaling, and the cycle compounds. Conversely, emotional pyramiding, adding to a position driven by fear, greed, or hope, erodes capital and inflates risk. It is the path of amateurs masquerading as professionals. The 10-trade challenge tests this principle with precision. After learning to cut losses swiftly, size trades small, and wait for confirmation, the final test is whether you can pyramid appropriately. Can you resist the urge to average down a losing position, to make back what was lost? Can you instead wait for strength, then scale in a measured, rules-based manner? This discipline is the defining characteristic of professional maturity. Every trade becomes a behavioral litmus test. Do you react emotionally, or do you act logically? Can you maintain composure under uncertainty, or do you surrender to impulse? The answer determines long-term survival and prosperity. Pyramiding also bridges the principles of patience, loss control, and confirmation into one cohesive process. Cutting losses fast frees capital and protects freedom. Sizing small ensures errors remain tolerable. Waiting for confirmation filters noise and aligns probability. Adding to strength compounds opportunity without overexposure. Together, these behaviors create a repeatable framework that transcends individual trades or market conditions. They convert trading from episodic fortune to a structured system of accumulation. Livermore's success was never about a single lucky trade. It was about repeating this process consistently over time, leveraging confirmed strength into outsized gains, while mitigating the ever-present risk of catastrophic loss. Consider a practical scenario. You enter trade number 9 of the 10-trade challenge with a small, controlled position. The market moves in your favor but hesitates at a critical pivot. You resist adding prematurely. Then, as confirmation arrives, volume spikes, momentum aligns, and tape corroborates, you layer in another position. Each addition is justified by observation, not ego. By trade number 10, your original capital has expanded significantly, yet you remain fully aligned with probability and process. Contrast this with a trader who adds during hesitation, hoping for a reversal. One fails, the other compounds. The difference is the discipline of pyramiding. Psychologically, pyramiding reinforces confidence built on data rather than desire. Amateurs often scale into positions emotionally, creating stress, doubt, and exposure to ruin. Professionals scale systematically, allowing confirmation to dictate action, freeing the mind from unnecessary anxiety. Each step of pyramiding becomes a reinforcement of behavioral integrity, following rules, respecting risk, observing signals, and compounding gains without emotional interference. Livermore described this as letting the market finance conviction. The market validates every layer, ensuring that expansion of capital is always supported by evidence rather than hope. Another crucial aspect of pyramiding is its scalability across market conditions. Professionals recognize that trends mature at different paces, and patterns confirm differently. By layering in response to strength, they maintain alignment with evolving conditions. This adaptability prevents overcommitment, allows for measured participation, and ensures that risk remains proportional at every stage. Amateurs, by contrast, often lack this calibration, misjudging strength, overexposing capital, and leaving themselves vulnerable to reversal. Pyramiding is not static. It is dynamic, responsive, and grounded in observation. The final lesson of the 10-trade challenge is that success is less about perfect prediction and more about process fidelity. Livermore's legacy illustrates this principle vividly. He did not need to be right all the time. He needed to act correctly when right, cut losses when wrong, and scale exposure only when probability reinforced conviction. 10 trades at a time, he built habits that outlived his fortune. The challenge reframes trading from a sequence of bets into a behavioral framework. Cut losses fast, size small, wait for confirmation, and add to strength. These maxims define the DNA of the professional trader. Pyramiding also underscores the interplay of risk and reward. By adding only to strength, you ensure that each additional increment carries a high expected value relative to risk. The process converts disciplined observation into exponential profit. It allows traders to amplify the impact of successful trades while maintaining protection against error. This is the distinction between speculative guessing and systematic compounding. Livermore understood that consistent application of this principle created asymmetry, limited downside, unlimited potential, when probability confirms strength. At the end of the 10-trade challenge, reflecting on these 4 rules provides clarity. The journey begins with cutting losses fast, moves through sizing small to protect capital, advances with patience and waiting, and culminates in pyramiding confirmed strength. Together, these behaviors create a coherent system that converts discipline into results. Professionals internalize this framework. Amateurs ignore it at their peril. By integrating loss management, size control, patience, and pyramiding, a trader develops the skill set necessary to thrive repeatedly, even under adverse market conditions. Livermore's approach also emphasizes humility within scaling. Adding to strength is not a license for arrogance or emotional overreach. It is a disciplined acknowledgement that the market has validated your thesis. Each layer added is a response, not an assertion. This mindset maintains balance between confidence and caution, ensuring that growth is proportional and sustainable. By contrast, the amateur pyramids emotionally, risking everything on hope rather than evidence. Finally, the principle of pyramiding links back to the foundational lessons of the 10-trade challenge. Cutting losses fast ensures survivability. Sizing small preserves flexibility. Waiting for confirmation sharpens judgment. Pyramiding strength converts all of these principles into compounding opportunity. The loop is complete. Defense becomes offense. Patience becomes capital. Discipline becomes profit. By following Livermore's blueprint, the trader transforms a week-long challenge into a behavioral reset, building habits that can endure across decades and cycles. The ultimate test is not the number of trades taken or profits booked. It is adherence to process under pressure. Can you cut losses without hesitation? Can you size trades conservatively? Can you sit quietly, waiting for confirmation? Can you add only to strength? Master these behaviors, and the market becomes a partner rather than an adversary. This is the essence of the professional's pyramid, the final stage in the 10-trade challenge, and the cornerstone of Livermore's enduring legacy. As you conclude this challenge, remember the unbreakable maxims: cut losses fast, size small, wait for confirmation, add to strength. These are not tips, they are behavioral laws. The 10-trade challenge ends, but the lessons continue. By internalizing these principles, you build a foundation for repeated success, compounding both capital and skill. The natural next step, which we will explore in the following episode, is Livermore's method of market timing: how to enter trends at their pivotal point, maximize confirmation, and continue scaling positions intelligently. The DNA of a professional trader is complete, but the journey toward mastery never stops.